I'm Dr. Zeba, Assistant Professor in the Department of Home Science, Aligarh Muslim University, Aligarh. Today, we will be beginning with a new module, Financial Management. Following are the contents as you can already see in the slide. These are money management, budgeting and accounting, cost control methods 1, cost control methods 2, and saving and investment. A very interesting and important aspect of financial management is money management. So, we will start with the first topic. In this module, we will explore the basics of money management. We will begin by understanding its meaning, key concepts, and scope. We will also look at its financial goals and finally learn about the core and innovative money functions. Let's begin with understanding what the term money management means. When we think about money management, we usually think of budgeting our pocket money, planning monthly expenses, or even saving for something we really want. In the same way, organizations also need to plan, organize, and control their financial resources carefully. Just like managing money wisely helps us meet our personal goals, financial management helps firms achieve their business goals effectively. Money management is about the planning and control of a firm's financial resources. Until 1890, it was considered a branch of economics, but over time it has grown into a separate discipline. The subject interests two main groups, academicians and practicing managers. For academicians, it is fascinating because the field is still evolving with many questions yet to be answered. And for practicing managers, it is vital since the most crucial decisions in a firm are finance or money related. A sound understanding of money management enables them to make effective and accurate decisions. So, we are now going to explore the true meaning of money management. It is a long term decision making process. It requires careful planning, proper allocation of funds, financial discipline, and strategic thinking. In fact, no one can imagine starting or running a business without financial knowledge and effective management strategies. Finance is not something that stands alone. It directly connects with other functional areas such as marketing, production, and personal. Without finance, these departments cannot function smoothly. For better understanding, let's look at the nature of money management in relation to other disciplines. Money management is multidisciplinary, drawing attention from accounting, banking, inflation, and the economy for effective resource use. It is not a separate entity but is integrated across all areas of management. Its scope extends beyond business, serving as the backbone of commerce, economics, and industry. Even operational and functional managers engage in financial tasks such as planning, budgeting, and resource control. Thus, money management is not confined to finance professionals, it is a shared responsibility at all levels of management. Now, let's move on to some basic terms used in money management. First, we have assets. These are the resources a business owns and they are expected to provide future benefits such as cash inflows. Next, we have liabilities. It represents the borrowings or obligations of the firm, essentially what the business owes to others. Finally, we come to net worth. This is simply the difference between assets and liabilities, and it reflects the true value of the firm. Having gained the understanding of money management, we are now in a position to comprehend about assets. There are two types of assets, real and financial. Let's learn the difference between the two. Real assets are tangible, physical items like land, buildings, equipment, vehicles, ATMs, and machinery. They are used in business operations and generate income through production, rent, or sales. On the other hand, financial assets are intangible. These include stocks, bonds, shares, debentures, loans, reserves, and bank balances. They represent ownership or a claim on income and wealth and provide returns through dividends, interest, or capital gains. These are traded in markets and also include leases and borrowings. Next, we are going to learn about the ways through which a company can raise capital. The first one is through equity. It refers to a company's own funds. It represents ownership where shareholders hold voting rights. Their return comes through dividends, but these are not guaranteed. The second one is through debt, which means borrowed funds like loans or debentures. Thus, equity is ownership with uncertain returns, while debt is borrowing with fixed obligations. Now, when it comes to raising finance or money, companies have several other options. For long-term needs, that is, money required for many years, they have four main options. First, equity shares, where the company issues shares to the public through the stock market. Second is preference shares, in which investors get a fixed dividend. And third is retained earnings, where instead of paying out all profits, the company reinvests a portion back into the business. And fourth is debentures, where the company borrows from the public and pays them interest. For medium or short term needs, companies use public deposits, loans, or overdrafts from commercial banks and financial institutions. Another way to raise capital is through creditors or lenders. They are not owners but provide loans or debt for a fixed time and charge interest. For the company, interest is a legal obligation. Firms can borrow from banks, financial institutions, the public, or by issuing bonds and debentures. A bond or debenture is simply a certificate of loan that states the amount, interest rate, and repayment date, and it can be traded in the market. Since the main goal of money management is to secure funds for both short and long term needs, let's now look at the key money functions that help a finance manager achieve this. First, the finance manager must estimate financial needs, both short term and long term, and prepare a proper plan. Second, they need to decide the capital structure, that is, the right mix of equity, debt, and other securities. And third, they should select the most suitable source of finance, whether it is shares, debentures, banks, or financial institutions depending on the need. Next comes the investment pattern, which means deciding how funds will be used, mainly for fixed assets and working capital, often with tools like capital budgeting. Then comes cash management, ensuring smooth cash flow so there is no shortage and no idle funds. Financial controls are also important. Techniques like budgeting, ratio analysis, and cost control help evaluate performance and make corrections. Finally, the proper use of surplus profits should be used wisely for dividends, business expansion, or diversification while protecting shareholders' interests. The objective of money management is to manage a company's investments and financing effectively. The two main approaches to achieve these objectives are profit maximization and wealth maximization. Since investment and financing decisions are continuous, the primary financial goal should be maximizing shareholders' wealth reflected in the market value of shares. Let's take a closer look at what is meant by profit maximization. It is one of the traditional goals of financial management. It focuses on decisions that raise profits and avoids those that reduce them. Profit can be seen in two ways: owner oriented, meaning returns to owners, and operational, meaning the overall profitability of the business. Profit is a key measure of efficiency. It reduces business risk and serves as the main source of finance. But this approach has its limitations. It can lead to exploitation, unfair practices, corruption, and inequality among stakeholders. When we talk about profit, it can mean many things: gross profit, net profit, profit before tax, or even profit per share. So the term itself is not very precise. Another limitation is the time value of money. Profit maximization looks only at the amount, but in finance, timing matters. A rupee today is more valuable than one received later. It also ignores uncertainty. Two firms may expect the same profit, but if one has unstable earnings, it carries higher risk. Often smaller but steady profits are safer. Finally, profit maximization overlooks quality. It focuses only on money and ignores factors like product quality, reputation, or technology which add long term value. Then there is wealth maximization. It is a modern and widely accepted goal of money management. Here, wealth means the value of shareholders' ownership in the company. Unlike profit maximization, this approach looks at long term value. It considers both risk and the time value of money, and it focuses on cash flows rather than just accounting profits. In simple terms, good financial decisions increase the market value of shares while poor ones reduce it. That is why wealth maximization is seen as a better and more reliable objective than profit maximization. Let's now compare profit maximization and wealth maximization. Profit maximization focuses on short term earnings. It pushes managers to cut costs, avoid discretionary spending like advertising, and set higher prices to boost margins. But this approach often ignores risk and long term growth. On the other hand, wealth maximization looks at the bigger picture. It emphasizes increasing the long term value of the business. Here, companies invest in capacity, research, advertising, and risk management, even if short term profits are lower. So, profit maximization is short term focused, while wealth maximization ensures sustainable growth and higher shareholder value over time. Moving on to the next topic, let's talk about the functions of money. In business, finance often overlaps with production, marketing, and other activities, but money functions can still be clearly identified. There are four important money functions. These are investment decision, financing decision, dividend decision, and liquidity decision. It's important to remember that these functions don't happen one after another. They happen simultaneously and continuously. They also require proper planning, control, and execution. And above all, the ultimate aim of every financial decision is to maximize the wealth of shareholders. Let's now go through each of the money functions one by one. The first and most important is the investment decision, also called capital budgeting. This simply means deciding where to allocate funds into long term assets. The key points of capital budgeting are to evaluate how profitable new investments are, compare returns with the cutoff rate, keeping in mind future uncertainty and risk, replacing unproductive assets with better options, and finally using opportunity cost to set the correct required rate of return. The next function is the financing decision. This is about deciding when, where, and how a business should raise funds. Funds can come from equity, debt, or other sources. The right balance between equity and debt is called the capital structure. A good financial structure maximizes the value of shares, which means growth for the company and wealth for shareholders. But one thing we should remember is debt increases returns while also increasing risk. The goal is to achieve an optimum capital structure, one that maximizes returns with minimum risk. Dividend decision is another important function. Here, the financial manager decides whether to distribute profits, retain them, or split between the two. The goal is to set an optimum dividend policy that maximizes firm value. Usually, companies pay profits as cash dividends or give bonus shares, which are extra shares given free to existing shareholders. While doing this, the manager must also think about stability, making sure dividends are fair and consistent. The last function is the liquidity decision. A company must always keep enough liquidity to avoid insolvency. This means balancing profitability and liquidity by investing carefully in current assets. Current assets give safety but earn little, so they should be reviewed and disposed of if unproductive. They also act as a backup in times of cash problems. In short, liquidity decisions influence not just finance but also production, marketing, growth, and ultimately the value of the firm. So, to conclude, money has four key functions: investment, financing, dividend, and liquidity. The investment decision is about where to put funds in long term assets. The financing decision is about how to raise those funds. The dividend decision is about how profits are shared or retained, and the liquidity decision is about keeping enough cash to run smoothly. Together, they aim to maximize shareholders' wealth and the firm's value. Having done with money functions, let's now explore the innovative functions of money. Nowadays, the financial manager is a key part of top management. Unlike earlier times of simple record keeping, they are now deeply involved in decision making. Their main responsibility is to allocate capital wisely, shaping the future of the firm. They must plan ahead, use funds efficiently, and think broadly because every decision affects profitability, growth, risk, and ultimately the value of the company. This dynamic role emerged with the modern approach to financial management. The first function is fundraising. Traditionally, money management means arranging funds. Finance managers were called during big events like expansions or mergers, and daily they just ensured enough cash flow. Even the textbooks until the 1950s focused only on ways to raise money. But this approach had limits. It ignored fund allocation, overemphasized procurement, and neglected daily decisions. So, finance managers were seen more as cash arrangers than decision makers. The second function is fund allocation. It is the modern approach. After the 1950s, businesses need not just to raise money but to use it wisely. The focus shifted from simply arranging funds to efficient allocation for growth. Money became central to management, helping firms decide how big should the company be and how fast should it grow. What assets should it hold? How should funds be raised? In short, modern financial management is about making smart investment, financing, and dividend decisions to optimize resources and support long term success. The third function is profit planning. It means planning how the business will earn profits. This involves decisions on pricing, cost, output, and product mix. We look at the cost structure. Fixed costs like rent and salaries stay the same. Variable costs like raw materials change with sales. Since fixed costs don't change, profits rise or fall faster than sales. This is called operating leverage. Profit planning helps managers link sales, costs, and profits and make smart choices to keep the company profitable. The fourth function is understanding capital markets. Capital markets link investors and companies. Financial managers need to know how these markets work and how investors view risk and value. If a company takes on too much debt, investors may see it as risky and its share price can drop. Successful companies are often expected to reinvest profits, not just give dividends. Investors judge managers' decisions by looking at risk and return. In short, understanding capital markets helps managers balance risk, return, and investor expectations for the company's survival and growth. The fifth function is status and duties of finance executives. The CFO, that is Chief Financial Officer, is the top finance executive, sometimes called finance manager, director of finance, or vice president of finance. The CFO shapes policies and ensures financial planning and control. In large firms, the CFO is supported by treasurer who manages funds, cash flow, credit and banking relations, and controller who handles reports, audits, budgeting, inventory and taxes. Thus the CFO ensures financial health. The treasurer manages money flow and the controller ensures accurate reporting. The sixth function is controllers and treasurers functions in India. In the United States, there are two separate roles. The controller looks after accounting and financial reports, and the treasurer manages funds, investments, and investor relations. But in India, this division is uncommon. The controller usually works like a chief accountant, and the title treasurer is rarely used. Some of those tasks are handled by the company secretary. Instead, Indian companies often use the title financial manager or finance director. Their main role is to manage funds carefully, since money is the most valuable resource for any business. So, to wrap up the six key functions of money management, we now conclude investment decision means choosing the right projects to put money into. Financing decision means deciding how to raise funds, whether through debt or equity. Dividend decisions are for balancing between rewarding shareholders and reinvesting profits. Understanding capital markets is about knowing how investors view risk and company value, and finance executive duties include CFO, treasurer, and controller handling specific tasks. In short, all these functions together help a company survive, grow, and create long term value. I hope this lecture helped you clearly understand the fundamentals of money management. Thank you for your attention.